with Save Mass Group of Companies, and I have my own accounting practice. So for today's session, I wanted to touch a little bit about taxes, a little bit on accounting, and a little bit about the services that I provide. First and foremost, you have my phone and contact information on your screen. So if you ever need any help in terms of your bookkeeping, taxation, or accounting needs, I'll be more than happy to assist you. So today's topic, we wanted to, work with realtors. We wanted to, talk a little bit more about some of the pressing issues that realtors face and how they can minimize those taxes, how they can, have a little bit of more income strategy in terms of how they can make a little bit more income in that sense as well. So thank you very much once again for joining in, and let's get started. Right. Let me get remote control on as well.
So Lakshay, just to mention to everybody as well is that we are now live on Facebook, on YouTube, as well as on LinkedIn. So if they want to join there, they can as well. So today, Lakshay is talking about tips to reduce 100K in taxes as a realtor. So welcome to the audience who have joined us on Facebook, LinkedIn, and YouTube.
Perfect.
Yeah, go ahead, Lakshay.
Give me 1 second. I'm just trying to start video as well so everyone can see me. Perfect. All right. So today's agenda is basically how to, as a realtor, we minimize your taxes. So first and foremost, I want to talk about how PREC and incorporation can benefit realtors. Then we're going to follow it by two expense strategies, two income strategies, and then we're going to conclude. So let's get started. So how can you save taxes? Like the heading said, saving 100K in taxes is a lot of amount. So I'm sure a lot of people are looking for some insights as to how they can save on those taxes. So first and foremost, let me see here. All right. So first and foremost, as a real estate agent, you pay taxes based on your income slabs. So if you're a sole proprietor realtor, you'll be paying approximately 0 to 40,000. You'll have a separate tab, and then if you're making 43 to 47, you're going to be paying more taxes, and so on and so forth. So as you reach approximately over $200,000 of income, you are technically sitting under the 53.53% tab. So what does that mean? It means in Canada, as you make more money, you pay more taxes. But if you are incorporated, then the taxes are significantly different. If you're an incorporated individual, you would be paying only $500,000 in tax. You will be paying only 12.2% taxes on the first $500,000 of income. So instead of paying more and more taxes as you make more money, you are technically only paying 12.2%, whereas on the other side, sole proprietor, you're paying more and more taxes. So that kind of, gives you a good perspective as to why incorporating would be a good option. So for those of you who don't know, realtors did not have the opportunity to incorporate their business up until October of 2020. Before that, accountants, lawyers, and medical practitioners, we all had the opportunity to incorporate, but realtors only recently got this opportunity to incorporate. So I highly recommend, incorporate your business and pay lower taxes, because who wants to pay 53% taxes on over $200,000 of income? So now that the PREC is open, it basically becomes a small business. As a small business, you would have salaries, you would have expenses, you have different sorts of things that happen in your business. So when you incorporate, you first and foremost need to open your own personal bank account, which will be, operated under your personal real estate corporation, your PREC. And from that PREC, a lot of the people, now, before the PREC, they were getting checks under their personal name. Now they wonder, all of these checks are being recorded under the PREC, which is the numbered company. So how do they technically take money out if they want to be, if they are operating under the PREC? So we all know that you can, from your business, you can pay yourself a salary. We can also pay yourself a dividend. The salary, gets set as an expense on the corporation. So for a corporation, a salary is an expense, but it gets added to your personal income. As a dividend, if you want, you can take out money from the retained earnings, but it also gets added to your personal income. So now you must be wondering, most of the money that I have earned, $200,000-300,000, they're all sitting under the corporation. How do I take that money out from the corporation, and how do I, start using it? So first and foremost, you take out your salary of $40,000. And we all know $40,000 salary is not much and you need more money. So the second layer you can do is you can take out another 20,000 from your business as a dividend. So 40,000 is taken out for a salary, which is the lowest tax bracket. Then you take it out as a dividend, which is 20,000. Again, not big of a tax jump. Your total income will become 60,000 as personally. So as you're withdrawing more and more money, you can see you're going to be ending up paying more and more taxes. And corporation, basically whatever is not needed, corporation keeps it, and corporation will pay corporate taxes, which is 12.2% up until $500,000 of income. So typically, you can write off your car expenses up to 75%, your meals and entertainment up to 50%, and your 15% would be your home office expenses. So all of these expenses would technically be taken out from your PREC and would be used on your day-to-day business activity as well as your personal self. So now let's look at an example as to what I explained in the previous slide, how the taxation was working out and how 100K of taxes can be saved by incorporating. So in this scenario, what I'm assuming is, in this example, you are earning $400,000 of income. If you earn $400,000 of income, that means you're going to have some expenses, some rent, utilities, advertising. After $55,000 of expenses, you are left with a net income of $345,000. As a sole proprietor agent, we know 345,000 is over 200. That means you are paying the 50% tax bracket. That 50% tax bracket, takes away most of your income in taxes, and you'll be paying $184,000 in taxes approximately. Now let's look at the same example under the PREC model. If you are earning $400,000 under your personal real estate corporation, you will be paying at same level of expenses, advertising, rent, and utilities, and you can pay yourself a personal salary of $45,000. You can pay your wife and your kids a salary as well, which is tax on split income of another $35,000, and you will be left with through 265. On the 45,000 and the 35,000, you'll be paying personal taxes, which is approximately 10,000 and 7,000. And on the business income, which is 265,000, you will be paying business taxes, which is 32,000. So overall, your tax liability is 10 plus 7 plus 32, which is 50,000. Whereas with the PREC, you are able to save 134,000 because under the sole proprietor agent, you weren't able to do that. You were paying all of this in taxes. So why is PREC beneficial? The simple need is, if you are earning more than what you need on a day-to-day basis, you should incorporate. So what it means is, when you are incorporating, you're technically leaving some of the money in the corporation, which is subject to lower taxes. That means you are direct tax savings and you're deferring taxes. So it's not until you will take money out of your corporation, it will get added to your personal income and you will pay taxes. So it allows you to do some income splitting. So for example, if you have a child which is 16, 17, 18, you can involve them in flyer distribution activities. If you have a wife, she can help you out. Maybe if she's in the lower tax bracket, we can take her help with the MLS listings and things like that. So all of these can be technically structured in a way where you're paying your wife a medium salary as well as your kids some salary, and both of their lower tax brackets can be used in order to effectively minimize your taxes. That is one of the biggest advantage. And now let's assume 10 years down the road you have, a big client list, and you are running sort of a team model where you have some sort of a gain accrued in the business. We all know that there is in Canada called something called capital gains exemption. What it means is if you are in the business and you technically retire and you sell the business, or if you decide to change a business and you sell it, the capital gain on the first $800,000 is actually exempt of taxes. So by incorporating your prep and structuring this model, you are able to basically save on almost $800,000 of capital gain, because the first 800,000 of capital gain is exempt in Canada. So now that we have talked about what are the benefits of personal real estate corporation, how the taxes can be minimized with the PREC, let's look at a few expense strategies, because someone might say that a $40,000 or $45,000 salary is not enough. So how do I take more money out? I gave you a dividend option, another 20,000, even at 60,000. Some people, you have more expenses than that. So how can we take more money out? These are the two expense strategies where you can actually take money out from the corporation by paying using the corporation's money. Usually, when we pay money to ourselves, it gets added to our income and we pay taxes based on income slabs. But if you use this strategy, you can technically use directly the money from the corporation and not pay yourself and pay to the insurance companies and help with the tax minimization. Once again, I'm not an insurance broker, so you might want to talk to your insurance broker to help get this set up. But in a broader sense, I'll give you an example of what I mean by these two strategies. Number one is key person insurance, and number two is health savings account. They're both insurance related. So key person insurance is technically an insurance for the director. If you are the director of the company and you have some sort of you are the only person working for the company, you can get an insurance under, everyone has insurance. So instead of getting insurance under a personal name and paying personally, you can get your corporation to buy insurance for you and pay premium from the insurance company directly, from your PREC to the insurance company directly. What this does is, instead of withdrawing money from PREC just to pay the insurance company, you are getting a deduction on the corporation, and you are using the money of the corporation to pay for your personal insurance. So key person insurance is definitely a good way to use it. Most of the time, this is helpful for people who have money sitting in the corporation. If you earn a couple $100,000, you've used 100,000, and then you have another 50 to 60, 70, or 100,000 sitting in the corporation, and you're wondering, how do I use the money that is already sitting in the corporation? You can buy a key person insurance. This will help you in tax minimization, because you are technically not withdrawing the money under a personal name. You are using the corporation's money to pay directly to the insurance company. And in this scenario, if you have, let's say, returned earnings sitting in the corporation, you can buy investment property. Someone might say that, why should I buy an insurance when I can buy an investment, or when I can earn some passive income? Do remember that when you withdraw money from your personal incorporate, like your PREC, to invest in like a house or something, any capital gains or any income that you will earn by selling a house or buying a house would be considered passive income. And passive income is again taxed at 50% taxes. So by using the key person insurance, it might be, tax efficient, but in terms of dollar impact, maybe you're able to make more money in an investment. So I'll leave that decision up to you. But key person insurance is definitely can help you in minimizing your taxes. Health savings account. The number two option is having a health savings account. What this allows you to do is, it is similar to getting an insurance from your employer. So a lot of the people who are working in the IT or different fields, they get insurance paid or an insurance coverage from their employer. But as a realtor, you are an independent agent. An independent contractor or independent agent, you do not have that personal insurance to cover your medical bills. So how can you use corporations' money to pay for your personal medical expenses that are technically not covered? So I had an uncle who recently had a laser eye surgery, and we all know LASIK is actually not covered under any of the insurance plans. So how can I use the corporation's money to pay for my laser eye surgery or something that is related to dentures for my parents? I can open a health savings account. Health savings account is something that allows you to deduct 100%. Yes, you heard it right, 100% of the premium from your corporation. So basically, what happens is you pay for the surgery or you pay for the treatment yourself, and then you use your corporation's money to reimburse yourself for the money for that you have paid personally. This is a great way for someone to use corporation's money without having the additional tax liability, because once again, if we withdraw money from the corporation, we are paying taxes. If we are paying directly as an expense from the corporation, we don't pay the personal taxes by adding it to our personal income. So it's a good strategy to use for someone who has, a dental braces, physio, or laser eye surgery, or even prescription glasses and things like that. They can all be covered by the health savings account. And once again, the cool part about this health savings account is this can cover expenses up until 2 years from today. So it can even go in 2 years in the past. So even if you didn't have it open 2 years ago, but you had a couple of surgeries done within your family, you can open it today and backdate and submit all of the receipts from 2 years ago and get a reimbursement. So some things to definitely think about and use in your day-to-day life. Now that we have talked about the PREC, we have talked about two expense strategies, how we can use money from the corporation. Let's talk about how you can make more money. So let's talk about two income strategies. So number one is using your own money from your PREC to do private lending. And the second strategy is how you navigate non-resident speculation tax. So a lot of the people already know that there's something called private lending, promissory notes, and second mortgages. What happens in this scenario? If you have money sitting in the PREC, and we all know that now the appraisals are coming smaller than the what the lower than what the house value that you bought them at was. So let's assume you might have helped a client close on a deal in February, but the closing was 6 months later, and now the appraisal is $200,000 less. You still want the deal to go through. So how can you use the money that is sitting under your PREC to kind of help them close the deal? This is the way you can lend them money of your own from your PREC, and there are two ways to do that. Number one is promissory note, and number two is second mortgages. Promissory note is something that is a little bit more informal. This would be something for a family member where they have a short-term need where they need money, and you get a small promissory note letter signed and lend them at a 12% interest rate. There is no lien, there's no second mortgage, there's no lien on the property, and you just do it as a favor. Second mortgage commitment letter, which is the second way of lending money, is actually more formal. This would involve a paralegal. You would have to have an interest as well as lending fee charged to the people. So let's talk about both the options. So option number one is promissory note, where you have, in this scenario, someone needed 60,000 as a loan, and you give them at a 12% interest rate. So what you're going to do is at 12% interest rate, it works out to $600 for 6 months. So 12% times 60,000 works out to approximately 7,200 divided by 12 works out to 600 a month. Because they're only borrowing for 6 months, we're going to give them a monthly payment of 600,000. And at the end of the 6 months, you're going to ask for a full principal repayment of 60,000, and that is it. And you close the deal. No other. There's no lien. There's no discharge letter involved. But now let's look at a more formal way. If there's someone who wants to borrow money, but and they have a property and they're on their name, what you can do is give them a loan by putting something collateral or putting something on the putting a lien on their mortgage or an existing investment property. So in this scenario, if the person is unknown, you can give them a loan of 60,000, and in this scenario you would charge them 12% interest plus the lending fee. And the cool part about lending fees is, when you're giving them money, you technically shave off the lending fee before writing them a check. So right off the bat, the loan was 60,000, but you will write them a check of $57,000 because you're subtracting the 5% lending fee before giving them the money. Same scenario where the term is 6 months, the monthly payment is 600 a month. You're going to lend them money, and they're going to pay you monthly installments of 600 a month. You would need to involve like a paralegal to register the lien on their property, because you don't know them. You don't, what if they run away with the money? So by putting a lien on a property against your 60,000, you're securing yourself. And uh, you first involve the paralegal to first put the lien on, and at the end of the time when they pay you back, you basically write them a discharge letter and discharge the property off the lien. So both the items are something that you can use to earn more income. Promissory note or second mortgage, both are cool ways to actually make use of the money that you have in your prec. What is the second way and the final way of increasing some of the money that you can earn as a realtor? A lot of us know non-resident speculation tax is something that is brand new, that will be banning foreign buyers for 2 years starting January 1, 2023. And currently, if you have someone who is an international student or a work permit holder, you might be unsure that if they can invest or not. What the NRST says is any non-resident in Canada will now be paying 20% taxes. So instead of 15%, you'll now be paying 20% taxes to buy a house. So if a house is $1 million, you'll have to pay 1.2 million, which is additional $200,000 of 20% of a million at the time of closing to close that property. So if you're an international student or work permit holder, can you buy this property? The answer is yes. You can buy it, and you would need to pay the additional NRST. But what you can do is you can claim the money back from the government. So if you're a foreign national who become resident in 90 days, or after becoming a foreign national who is on the path of getting a permanent residency, they can apply for a rebate and get the NRST back. So once you become a Canadian resident, you have 90 days to apply for this rebate. So definitely, encourage your international students or work permit holders that you might be working with as a client to buy the property, because they can get the money back. Even the international students and foreign nationals have criteria of applying for this. For international students, they need to be enrolled in full-time education. And for foreign nationals, they must be working at least 1 year before they need to show 1 year's worth of employment before they can buy the house. And after and within 4 years of closing, if they get their PR, they can apply for getting the rebate back for the NRST. So something to think about, and consider. If you have clients that are looking to buy but are unsure, tell them that you can still buy and get the money back as form of a rebate if they can become permanent resident, or if they meet the qualifying criteria. And now you must be wondering, how can we totally avoid paying the NRST? So usually NRST is subject to the entire Ontario up until 6 units. So if you're buying a multi-residential unit with more than 6 units, and that becomes technically outside of the scope of NRST. So you can avoid paying NRST if you're buying a building with more than 6 units. Even if you're buying agricultural land or maybe an industrial land or commercial land that doesn't have a residential component to it, you can still avoid paying NRST. So it's something to definitely think about to earn that extra income, to earn that extra commission, and guide your clients in the right direction. And that kind of sums up today's presentation. We talked about a few different things today, We involved basically we basically talked about the prec. We talked about the benefits of prec, how we can use the money inside the prec to split income with our family members to pay lower taxes, and how we can use two of the new expense categories to use the money from the prec to 100% deducted against income. And then we talked about two income strategies that can also help you as a realtor. So hope this session was worthwhile, and I'll open the board now for questions. Thank you very much for listening.
Thank you, Lakshay. Thank you for this presentation.
Thank you.
Hello.
Yes, Ashutosh.
Yes. So basically, do you recommend a break for the new realtors whose earning is, the less than 100,000 a year? Is it beneficial for them?
Yes, that's the thing is the answer really depends. If is it beneficial to earn? So let's assume you're earning $100,000 of income.
Yes.
It doesn't make sense to incorporate up until like $60,000 of income because you need the first 60,000. But what if your wife was working and she was making $100,000 as well? At that time, it makes sense to incorporate from the get-go. It makes sense to right away, incorporate and use the money to kind of help your to basically pay lower taxes, because your wife's income, you're paying taxes already. So now what's the point of paying taxes on your income as well? If you're the sole earner and you're only earning 100,000 as family income, you might need to use the whole income. Then it doesn't even make sense to incorporate even at 100,000, right? So it really depends. Does that answer your question, Ashutosh?
Yes.
Perfect. Thank you.
I have a second question also.
Go ahead.
That's the real scenario. I got a call from one of my investor. He is looking to buy a property close to Square One.
Okay.
But in a partnership with one of his partner who is the green card holder, Indian citizen and green card holder in the US.
Okay.
So he was asking, they have to pay the NRST because the one partner is not a Canadian resident. Basically the US resident.
Okay.
So normally, what I'm thinking that yes, they have to pay if it's a partnership. Even the one partner is a Canadian citizen, I think they have to pay the NRST.
Absolutely, you're right. So if you have someone who you're partnering up to buy a house just to avoid the NRST, so let's assume I am a Canadian citizen and I partner up with one of my cousin who's a foreign national, and I think that if we get together to buy this house, we'll avoid paying the NRST. The answer is no. You cannot avoid it. The only way you can avoid it is if you were to invest in a multiplex residential unit which has more than 6 units, or you're going for an agricultural, industrial, or commercial property. Only those criteria you can basically avoid paying the taxes.
Thank you. Thanks a lot.
Welcome. Any other questions, guys? We have 6 minutes. Once again, thank you for joining in. I hope this session was worthwhile, and a lot of people joined, and we are streaming live on Facebook as well as on LinkedIn. So even in future, if you want to join through other mediums and not Zoom, feel free, be my guest. But this is a recorded session, and I can share maybe a YouTube video after the recording is complete, and maybe you can look at it in your free time if you weren't able to participate. And moving forward,
Lakshay, can you please share the YouTube video link?
Absolutely, I will do.
Thank you, Lakshay.
Yeah.
Thanks again for coming on to the channel and sharing these tips. Most realtors have a problem earning 100K, but we at SaveMax don't. So these steps were beneficial for our realtors. So everybody out watching there, go through this presentation. We are have recorded it on the YouTube channel as well. So kindly subscribe to the channel as well, and reach out again, Lakshay. Again on next Tuesday, we will have the same thing. Correct?
Perfect. Next Tuesday as well, we will be doing another session at 2 p.m. So feel free to join that as well. And it will be a brand new topic. And if you have any topics you want me to cover in the future, feel free to message me. So I'll, prepare something and we can talk about that as well.
And
And
on the screen, Lakshay, right now we are displaying your contact information. So
yeah, so anyone who is looking to get the YouTube link or the recording, please email my the email link that you see on the screen, so we can basically get that running, and I'll reply back with the YouTube link as well as the presentation.
That's awesome. Thank you, Lakshay.
Perfect. All right, thank you very much, guys. Appreciate you joining in, and until next week, 2 p.m. Tuesday. See you.